Welcome everybody to our third quarter of 2026 webinar. Today we are going to be talking about the effects of inflation. This presentation is titled The Cost of Everything, Winning with Your Money in 2026. We will cover a lot of material today, but before we do so, I want to share some exciting news. For the second year in a row, we were named Best Financial Advisor in White Bear Lake Magazine. I want to take a moment to thank everybody that voted for us. And as you can see on the screen, our team continues to grow. So we have certainly seen good growth at Paladin. Our team is growing, and we want to thank all of our clients out there who have helped make that possible. This slide should look familiar to most of you out there. This is what we call the Paladin plan. And this is the driver for all of the various appointments that we do with folks. On the right, you'll see what we call the 4 pillars. So the 4 pillars are made up of your financial plan, your health plan, your tax plan, and your estate plan. At Paladin, we want to ensure that clients have all 4 of these pillars buttoned up as best as possible to ensure the best chance of success in retirement. We've covered various topics over the last several years with our webinars as well as with our podcast. Today, we're going to talk through inflation again, which is going to be a part of the financial plan. On the left, you'll see the 4 different stages of our appointment process. When we sit down with folks, that is number 1. That is the discovery session. Think of this as a chance for potential clients to interview us at Paladin and also us to interview you as well. We're just asking a lot of questions, finding out what concerns you have, what have you done so far, and seeing if there's a fit for Paladin to help serve you and improve your retirement plan. The second step would be you coming back and us actually delivering a full comprehensive financial plan to you. Then we spend about an hour and a half reviewing that plan, answering any questions. And this is really the launch point for an ongoing relationship. Delivery is us putting that plan into motion, and then continuity. So continuity, I think of it as nothing we do is set it and forget it. We want to make sure that our plans are always adjusted to give you the best chance of success. Now, things that may impact the plan could be things that we have no control over, like the economy, wars breaking out, what's happening in the stock market. There may be things that pop up in your life, whether it's a life milestone like retirement, or maybe an illness has come up that is going to change how life looks. So we're meeting on a regular basis, making sure that your plan is always up to date and giving you the best chance of success. Again, my name is Matt Bryant. I am one of the financial advisors here at Paladin. Today, we are going to be focusing on inflation. So, why does this matter? Everything feels so much more expensive than it used to. The things that you're interacting with on a daily basis, whether it's going to the grocery store, putting gas in the car to get to the grocery store or to work, clothing, travel, all these different things have become more expensive, and that is due to inflation. Inflation is looking at how prices are rising over any time period. The challenge isn't just earning more to try to offset that inflation, it's making smarter financial decisions along the way. A lot of the factors in inflation are things that are out of control. Over the last 12 months, for example, and this is for data ending June 2026, energy is up almost 16%, airfares are up 26%, car repairs are up 7%, food is up 3%, housing is up 3%. So across the board, really, things are increasing. Now, we may find pockets within the economy where things are maybe decreasing in prices, but by and large, things are increasing. Now, we may notice it more at the pump, for example, because energy is highly volatile and highly dependent upon what's happening geopolitically. And we know that there's been the conflict in Iran, which has caused gas prices, for example, to shoot up pretty dramatically here in 2026. Again, we cannot control the economy. What we can control is your financial strategy. A lot of these things are frustrating to have to deal with, but if you have a good financial plan, you should be able to navigate those. Hello, everybody, and welcome to the third quarter of 2026 webinar. Today, we're going to be focusing on inflation. The title of the presentation, as you can see, is The Cost of Everything, Winning with Your Money in 2026. We will be covering a lot of material today, but before we do so, I want to take a moment to share with you something that was exciting in our world. For the second year in a row, we were named Best Financial Advisor according to White Bear Lake Magazine. So I want to thank all of you out there that voted for us. We're definitely resonating with the clients that we have, and we appreciate your support. You can also see our team there continues to grow. And so as Paladin grows with the number of clients we are servicing, we are also seeing our staff grow, and we do appreciate all the clients that help make that a possibility. On the screen here is something that many of you probably recognize. It's what's called the Paladin Plan. There are two main components that go into the Paladin Plan. One is a written plan that we are using as an agenda every time we meet with you. It's a way to hold each other accountable to make sure things in your financial and retirement life are being addressed. The other side is the numeric plan. So this is the numbers that go into retirement. Both plans are things that we update on a regular basis. On the right, you will see the 4 pillars. So the 4 pillars to a successful retirement will encompass your financial plan, your tax plan, your estate plan, and your health plan. At Paladin, we want to work with all of our clients to ensure that all of these are buttoned up as well as possible. And we want to make sure that you have the best chance of success as we go forward. Today, the inflation section will fit primarily under the financial plan. On the left, you have an outline of our appointment process. So the first step is a discovery meeting. This is a chance for us to sit down with our potential clients, ask a lot of questions back and forth, get a feel for what is really driving the interest in having a financial advisor and seeing what can we do to help you out. After that meeting, we have a second meeting, which is the strategy session, where we build the financial plan, deliver it to you, and show you how this will improve your financial life and how we will put you on the path to a successful retirement. The delivery is the implementation of the plan. And then last is continuity. And when I talk about continuity, I like to think of it as nothing we do is set it and forget it. As soon as we have a good plan in place, things happen around us. Some may be out of our control. We may see an economy go into recession. There might be a war breaking out. Stock market might not be doing well. Maybe there's things in your personal life. Maybe there's milestones like retirements, or perhaps an illness that is changing what retirement looks like. So we meet on a regular basis. We're constantly updating the plan to give you the best chance of success. Again, my name is Matt Bryant. I am one of the financial advisors here at Paladin Financial. We do these webinars quarterly. Today, again, is about inflation. But I encourage you to go to our website, paladinfinancial.com, look for past webinars that we've done, and also our newly revamped podcast. We have a whole series of podcasts on a variety of topics that has a ton of good information. Hosted by Nikki Foley, and then all of us different advisors are guest presenters as well. So, inflation, why this matters. So, inflation, just to put it basic, is an increase in prices in the goods and services that we buy. If you are interacting, you're going about your job, you're driving to the grocery store, you're getting gas at the pump, all these things, you've seen prices increase. Now, they may be increasing more dramatically in certain sectors like energy prices. We especially feel that at the gas pump, due largely to the conflict in Iran that started earlier this year. But we've also seen airfare increase by 26%, driven partly by fuel costs. We've also seen car repairs increase by 7%. Food costs increasing 3%, housing up 3%. And these are all numbers from the Bureau of Labor Statistics that ended June of 2026. So what that shows us is, yes, prices are increasing pretty much across the board, but there are pockets that are increasing significantly more than other areas. And so while general inflation has slowed down, we are definitely seeing pockets that are making life a little bit more difficult than maybe it should be. The challenge isn't just earning more to try to offset that, it's looking inside your plan, inside your financials, and saying, hey, are there opportunities in here for me to get rid of certain things that I don't need or adjust my portfolio to better reflect that the environment that we are in? Again, you can't control the economy, you can't control the stock market. What you can do is control your financial strategy. So today's to-dos: identify where costs are increasing. I laid out a few of them on the previous slide. What can you actually do about it? Understanding the outlook and where things might be heading, and then opportunities for long-term proactive planning. So the inflation rate right now, depending on, there's a whole variety of different indicators out there, but the consumer price index right now is a little bit under 4%, which that's higher than what the Federal Reserve targets, which is about 2%. But that under 4% is significantly better than what we saw back in June of 2022 when inflation had spiked all the way to 9%. Now, if we look back over the last 7 years or so, the main driver for inflation spiking was COVID, which led to interest rates being slashed, which led to also a lot of stimulus money and then a lot of supply chain issues. All these things built up over the course of 1, 2, 3 years until we got to June of 2022 when inflation had spiked all the way to 9%. When you have all that money chasing fewer and fewer goods and services, that's what caused prices to increase as dramatically as they did. Since then, there's been an effort by the Federal Reserve to try to bring those interest rates down, and they have come down quite a bit since then. But we want to also know, as we sit here now, what is the outlook moving forward? How do we adjust our portfolio? How do we account for these prices? So we're going to cover a little bit of that further on. So inflation affects your purchasing power. For example, if we go back to January of 2019, pre-COVID, world was a little bit of a different place then, and you had $100, that $100 can purchase a lot more than that $100 would today. For example, it takes $132 to buy the same basket of goods that cost $100 just 7 years ago. So that's a pretty dramatic increase. And if you think about it not in terms of $100, but 10,000 or 100,000, then things are becoming dramatically more expensive. Even when inflation slows down, which is what we've seen over the last few years, it doesn't mean prices return to where they were before. Generally speaking, prices are going to always increase, and that's not necessarily a bad thing. It's good to have a little bit of inflation in the world because the opposite would be deflation, and that's a situation where signs are pointing towards a recession and layoffs, and that is not a good thing. However, we don't want to see it as high as it has been. There is a happy medium, and it seems like we are trending in that direction overall. Inflation, if you want an example, think of it as walking up an escalator that's going down. So your goal is to try to walk up faster than the down is taking you back to your starting point. That is where wage growth comes in. That is where wealth building by way of stock market comes in. There's things you can control to combat the effects of inflation, and then we're here to help you at Paladin. Take a step back and think, what expenses have increased the most for your family? It's going to look different for everybody. The 30 somethings with 3 or 4 kids that have activities all over the Twin Cities that are driving around, filling up the car on a regular basis. Those things are maybe looking a lot different than the retired couple who doesn't drive a lot and has spending needs that are a lot less and their house is paid off. So it looks a little bit different for everybody, but across the board, inflation is certainly happening. So one of the types of inflation we want to talk about is lifestyle inflation. Think of this as lifestyle creep, which is something I'm sure most people have heard of. Very typical. As our income goes up, our spending also increases. Sometimes the spending is still on those essential items that we have to buy, and costs are increasing with inflation. Other times we are seeing our lifestyle creep up and we're buying bigger homes, fancier cars. We're adding additional subscriptions. We're going out to eat more. Maybe we're spending more on travel, or our travel looks different. And so instead of road trips, now we're flying, we're going to other countries, that sort of thing. So it's natural. You're rewarding yourself. It's people are. It's just natural for costs to increase as you buy these nicer things as your income goes up. The point isn't to enjoy life as it's happening. The key, though, is invest in your future before you see your discretionary costs go up dramatically. What I mean by that is, hey, if your income is increasing, you should increase how much you're contributing to your various accounts that are invested in the stock market, because that long term is what's going to help build you wealth. So, yes, let's say you get a 5 or a 10% raise, or you get a bonus. Best course of action first is pay yourself, invest for your future, and then you can look at paying for these other things on top of that. Small expenses can be very detrimental over time. Uh, Nikki and I did a podcast here recently, and we actually talked a little bit about all the subscriptions we have and things to do. And I had recently canceled 3 subscriptions and didn't save a significant amount, maybe 150 bucks. But over the course of a year, 2 years, 3 years, that really starts to add up. There's something called frictionless commerce. That is where these companies make it as easy as possible for them to spend money, for you to spend money on their platform. Think about signing up for a streaming service or buying something through Amazon or buying coffee through Starbucks. Their goal is to make that experience as easy as possible. So it's something that you can do in a matter of a minute without even giving it much thought. However, that also makes it way too easy for our personal expenditures to increase. And that's something that we want to control. So impulse purchases, whether online or in person, interest charges, not paying off the credit cards every month, all these different things have a negative long-term effect on your financial plan. Very simple exercise that I try to stop and think about from time to time is, how many times in a week or a month, whatever time period, do you spend $20 on something that really isn't necessary? Now, extrapolate that over the course of a year, and we're looking at over $1,000 of tiny expenses that we probably could have done without, and it would not have changed our life at all. Now, imagine if that's $50 per time. Now we're looking at 2,500. Now, it's very easy to spend money on these tiny things because they don't really mean a lot in the moment. But if we step back over a period many months or a year, we can really see that not just are the prices of goods and services more expensive, it's really easy for us to spend money on those goods and services, oftentimes when we don't actually need them. Now, debt. Debt, as far as inflation goes, is a double-edged sword. There's good debt and there's bad debt. When you are looking at your personal costs increasing over time, we know we're spending more on these various goods and services, but we got to be very mindful of how we're paying for them. Credit cards, very easy to use, can actually be a benefit to a consumer if they're used properly and you're getting rewards but not paying interest. However, it's very easy to rack up a lot of debt. And we see it all the time here at Paladin when we sit down with folks, where it just quickly spirals and gets out of control. And then we're having to help put a plan together to get that debt paid off, because no one wants to be paying 20, 25, 30%, typically on things that you purchased that decrease in value or were consumed right away. Personal loans tend to have better rates, but also a slippery slope, and you can get yourself in trouble. Buy now, pay later. Even credit cards are offering this on your statement. Those are all things that you should focus on and have a high priority for paying off as soon as possible. Lower priority for payoff is mortgages, student loans. Those rates tend to be more favorable. those loans tend to be long term. There are some protections built in with those. Again, it'd be nice to have no debt across the board, but we want to look at the type of debt you have and say, hey, if I have the option, for example, of paying off um, my credit card or making a contribution to my IRA, like what do I do? So we're going to help you navigate those questions because really what we want to see is debt costing me more than what my investments are earning. If you think about having a nice portfolio that's growing with the stock market, but you got a pile of credit card debt at 20 or 30%, you're probably not coming out ahead. So how do we get this thing dialed in so that your money is working for you and not going to pay for goods and services that you don't really need? So consider the mortgage, paying it off early versus just letting the term carry out. This question comes up all the time, and I get it. People want to have no debt, especially when they enter into retirement. They want the house paid off as soon as possible. It doesn't always make sense to pay off the home early, though. So we will calculate with you what does it look like if I paid off my mortgage early or if I took those extra payments and invested them into a stock portfolio instead. So the variables we want to look at is your current rate. That's a huge one. If you refinance or purchased around COVID or before COVID, there's a good chance you have an interest rate in the twos, the threes, or the fours. Those out looking for homes right now are probably seeing interest rates in the sixes, maybe into the sevens. So that changes the calculus on whether it makes sense to pay off early or not. The length of time you plan to be in your home, what is your cash flow from jobs and other income sources? Do you have other debt that maybe should be addressed first, like those credit cards from the previous screen? And are your retirement savings on track? It's one thing to pay off the home as soon as possible, but if you do it at the expense of saving for retirement, you may not be coming out ahead. So what we want to do is say, hey, if we know we have X amount of dollars to save and put towards debt, what is the best use of that money? Obviously, there's a minimum for your mortgage. So let's look at, hey, if I spent an extra $500 on the mortgage, what does that look like now, 5 years, 10 years down the road? Or what if I invested it into a portfolio for growth? What does that look like 5, 10, 20 years down the road? So there is thought that needs to go into it. We're here to help you navigate that and say, hey, will I come out ahead or is there a better use for my money long term? So, how do we actually keep pace with inflation? We've talked about how to cut spending, reduce spending, looking at where those recurring charges are coming from, getting rid of the bad debt. But how do we keep up with inflation inside of our portfolio? Equities matter. If we look at all the things that we could possibly invest in for a blended portfolio that fits your specific profile, there's a good chance there may be safer components in there, like a variety of bonds. You may have middle of the road type money that is earmarked for the next 5 to 7 years, but then you should have long term money to help combat the effects of inflation and ensure you're building wealth for 10, 20, 30 years down the road. Cash provides stability. We like knowing that certain pieces of our portfolio aren't going to be changing significantly day to day, but investments and equities provide growth to the long-term side. We need to have a combination of each to ensure a solid financial plan. Historically, equities have been one of the few places that consistently outpaces inflation in the long run. If we're not outpacing inflation, our dollar that we're spending on goods and services is buying less and less. That's essentially losing, and we want to make sure that's not what happens to your plan. A diversified portfolio can protect your purchasing power, help build wealth, and also pay for the things that we need to get done in the short term. Remember, inflation long term, it's a problem, especially if it's elevated. A little bit of inflation is just fine and indicates a healthy economy, but growth investing done properly is a long term solution. However, building wealth is not enough. You need to protect your nest egg. You need to protect where your money is coming from. Emergency fund. Everybody has had some sort of emergency pop up, whether it's a car repair, maybe a child broke a bone, maybe you had need a new roof, whatever it may be. It's nice to have an emergency fund so that if life's curveballs happen, we are not disrupting our plan to pay for it. We have liquid reserves ready to go to help cover that. Disability insurance replaces income when you can't work. Perhaps you got sick or hurt. Life insurance replaces your income once you pass away for your survivors. So if you're a younger family, especially, or even in retirement, we want to look at what happens if one spouse passes away and is there need for coverage there. Health coverage, trying to keep costs as manageable as possible in a very expensive sector. Estate planning, protecting your assets, protecting your estate, making sure when you pass away, your wishes are actually carried out. Identity protection, this happens unfortunately. Scams are very prevalent. We're all getting bombarded almost on a daily basis, it seems. Just making sure that you are doing what you can to help protect yourself across these various areas. The idea behind protection is just to help navigate uncertainty and volatility and give us a little bit more reliability with our plan. So we want to look at when we have income coming in, what are the things that we have to spend money on? What are the things that we want to spend money on? And then how much money do we actually have to do it? Highly encourage you to review expenses regularly. And I say this a lot where making a lot of money can cover up a lot of bad mistakes where, oh, it's just fine. I'm making all this money. I don't really need to focus on my expenses. I'm making some investment contributions and it's fine. I'll get the spending under control when I retire. No, you need to be looking at where your expenses are going right now, seeing what wasted opportunities are in there, and try improving your situation incrementally. It doesn't have to be home runs every time. Little things like seeing where your money is going and canceling things that aren't necessary is one place to start. Review your investments. The investments that were best in 2019 when inflation was low versus the last 4, 5, 6 years when inflation has been a lot higher are different. You want to make sure that your investment plan is always keeping up with the environment that we are in. That goes back to when I said we don't do anything, set it and forget it as part of our financial planning. Things need to be tweaked and adjusted as time goes on. We're constantly making adjustments, trying to give your plan the best chance to succeed. Nothing is perfect. Perfection is impossible. However, with consistency, with doing things like rebalances in your portfolio, reviewing your spending, knowing where your money is going, knowing what's coming in, those things can help avoid major mistakes and increase your chances of success when it comes to your financial plan. There's always an opportunity to add value to your plan. You just need to sit down and be diligent about it. Having an advisor in your corner, like here at Paladin, that's a big thing that we can help focus on. So, as we get to wrapping up here, action steps. What are some things you can do? Track your spending. Even if you think you know exactly where all your money is going, spend some time to review credit card statements, bank statements over the last 30, 60, 90 days. You might be surprised to find out where some of that money is actually going. Automate your savings, recurring contributions, put it on autopilot. If you have extra money to invest on top of that, great. But typically, when people say, I'll just write a check at the end of the year, it's too easy to get that missed. So do things like increase your 401k contributions on an annual basis. Most plans allow you to automate that. Make sure you're doing your Roth contributions if you qualify. Make sure you have a non-qualified investment account. You need to have all these different buckets in place, but automate it to make life easier for you so you don't have to wonder when the last time you made that contribution was and was it sufficient enough. Evaluate your debt. Are we keeping that bad debt off the books? Are we analyzing our current debt, see if we can do anything better there? You can't plan for retirement in a day. This is a long journey. And once you actually make it to retirement, it's not done. We expect another decade, 2 decades, 3 decades in retirement. So the whole plan needs to be constantly built and tweaked and adjusted, because you can't do your retirement planning all in one day. So key takeaways: inflation changes the value of your money, and over time it can be quite significant. It can be even significant in short term, as we have seen gas prices, for example, increase dramatically. Negative lifestyle creep is a negative impact on our wealth and net worth. Be strategic with debt. Look for those spending leaks. All these different things are tools in our toolkit to control what we can control, ideally putting your plan in the position for the best chance of success. Again, you don't need a crystal ball. There is no such thing as perfection, but have a plan, be diligent, and have a professional in your corner to help navigate some of these things. All right, next steps. If you want additional information, if you want a consultation with one of us here at Paladin Financial, email us, info@paladinfinancial.com. Understand how inflation impacts you. If you don't know, certainly come in to see us. Evaluate opportunities that you can make now and into 2027 to improve your situation. Even if it's minor, those things add up over time. And of course, pick up the phone and call us, 651-842-8406. We'd be happy to have a conversation with you and set up an appointment here in the office if you would like. All right, so that wraps up the talk on inflation. However, stay tuned. We will have a few events coming up here over the next several months. September 22nd, we are going to focus on the health pillar of the 4 pillars. That's going to be at Vadnais Heights Commons. More details to come, but we will be talking about healthcare, health expenses, and things that you can do to help improve your situation there. And then November 23rd, we have our open house and pie giveaway. So this is the week of Thanksgiving. Come in, mingle. There's food and drink. There's no presentation really, but we want to get a chance to say thank you to all of our clients, and you're able to take a pie with you for the Thanksgiving holiday. So stay tuned on those and hope to see you there. Again, we're here to educate. We're here to serve. If you have any additional questions, or if anything piqued your interest and you want to learn more, please call us, 651-842-8406. We hope to talk to you soon. Thank you.